Hello guys, welcome back to a new video. So our today's topic is business cycle. The business cycle, also known as the economical cycle or trade cycle, is the downward and upward movement of gross domestic product around its long-term growth trend. Business cycle occurs due to the function that an economy experiences over time resulting from changes in economic growth. Business cycle is measured in terms of GDP. It is the economic performance of a country over a long run. Expansion phase. So there are four phases of business cycle. These are expansion phase, recession phase, depreciation phase, recovery phase. Expansion phase. The expansion phase is characterized by increased output, employment, investment, profit, sales, aggregate demand, bank credit, wholesale and retail prices, and rises in the standard of living. In the later stages of expansion, the inputs start falling short of their demand due to the which the price of the inputs, both labor and raw materials, increase. This shows that economic has reached its peak. The growth rate reaches the peak point and then eventually slows down. Recession phase. One of the primary business cycle phases is recession. A recession is a period of descending economic activity. The session is characterized by decreased investment, bank credit, stock prices rises. The depreciation phase. The economic reaches the depreciation phase when the economic activities fall below their normal level. This phase is characterized by a drastic reduction in the national income and other expenditures. Prices of consumer goods decline steadily. Unemployment increases. Recovery phase. The turning point from the depreciation to expansion is termed as the recovery phase. In the recovery phase, the economy gradually recovers the from the through when economy gets back to its normal trend. Economic may expand. Macroeconomic policies. The most important macroeconomics policies, the two most important macroeconomics policies are fiscal policy and monetary policy. Fiscal policy is the use of government revenue collection and expenditure to influence the economic. When the government changes the levels of taxation and government spending, it influences aggregate demand and the level of economic activity. Fiscal policy is often used to stabilize the economy over the course of business cycle. When the government announces a new budget, it defines revenue collection to expenditure. This is basically a fiscal policy. Discuss the types of various tools of fiscal policy. Expansion of fiscal policy, contractionary of fiscal policy. To control recession, government increase expenditure and reduces taxes. This type of policy is called expansionary fiscal policy, contractionary fiscal policy. This the tools of fiscal policy are budget budgetary policy. Government declares an annual budget where it determines the total government revenue expenditure. When total revenue, government expenditure. Taxation. Taxation is the process of determining taxes. It is government's revenue. Government earns from taxes and paid by the citizen. When government earns more, it can spend more. There are two types of tax: direct tax and indirect tax. Personal income tax and corporate income tax are direct taxes. Public borrowing, public debt. Government often borrows money from public. It is called public borrowing or public debt. Government can borrow money from the public through selling bonds. It often borrows money from different banks and financial institutions. When government borrows from the public, the total amount of money from the market is decreased. Thus, objective of fiscal policy. The objective of fiscal policy are described below. Full employment. The first and foremost objective of fiscal policy in a developing economy is to archive and maintain full employment in an economy to reduce Unemployment and underemployment. The state should spend sufficiently on social and economic overheads. This expenditure would help to create more employment opportunities and increase the productive efficiency in the economy. Price stability. When prices so give up, the inflation when the price. So guys, no more today. See you tomorrow.